Let's check out the Fed's current interest rate path. Joining us right now is former Cleveland Fed President Loretta Mester. She's now a senior scholar with Princeton University's Griswold Center, an adjunct professor of finance with UPenn's Wharton School, and a CNBC contributor. And Loretta, thank you for being with us this morning. I know that most of the market now thinks that a hike is more likely than a cut. But we had a portfolio manager who joined us earlier this morning who said that the Fed is missing this. And by the Fed's own data, it's really screaming for a market cut right now. He ran through a couple of things. He looked at the New York Fed data from the fourth quarter that showed overall household delinquencies were climbing to 4.8%. He said that's a red flag. He said the youth and non-college cohorts are absorbing the bulk of the asset pain here. And then he talked about Trichet and that 2008 parallel where the ECB actually hiked into higher oil prices and then had to reverse course because of what happened with the economy just after that. What would you say to him?
Well, I think the path of the war is going to determine the path of the economy, and then that's going to determine the path of monetary policy. And right now, we don't really know what's going to happen. So the Fed's going to be watching and assessing the risk. You know, when an oil price shock happens, and of course, with the closure of the Strait of Hormuz, it's also coupled with a supply constraint. What usually you see happen is there's upward pressure on prices and downward pressure on growth and employment. Right now, I think the Fed is rightly focused on the inflation risk of this shock. I mean, we've had inflation running hot and above the target for 5 years. And, you know, firms have already had to absorb higher tariffs. So that hit their margins. Now with the higher oil prices, that also is going to hurt their margins. So they may be more willing to hike at this point their own prices. And so the Fed has to be attuned to that possibility that this oil price shock isn't something that they can look through, that it may feed into broader based inflation. On the other hand, your contributor was correct in the sense that usually you see an oil price shock having putting some downward pressure on the economy, on the real economy, on employment and growth. And here I would say, you know, we're much more energy efficient than we were. And, you know, we also are an energy exporting country now. And so that sort of mitigates some of that downside effect. But, you know, the labor market is kind of in what I've been calling an uneasy balance. It is true that supply and demand in the labor market are balanced right now, but balanced at a low rate of hiring. So a shock could put it into imbalance, and then the Fed might have to take that into account later on. But right now, they need to be focused on the inflation side of the mandate and continue to assess that balance of risk to both sides of their mandate as we go forward.
Would you be leaning more towards a hike at this point or more towards just standing pat to see what happens next?
Yeah, I think what I would be for now is being on hold. I mean, I don't think they're going to take anything off the table, including rate hikes, in terms of what they're saying and what their actions have to be. But we just don't have information now that's showing that this energy price shock is showing through to broader based inflation. They're going to be looking for that. They're going to be watching inflation expectations to see if they're moving up. They're going to be watching other measures of inflation to see if prices are moving up. And they will be ready to react to that. But they have to balance that against what may be coming on the growth side from the downward risk to the employment part of the mandate. So right now, I think the right thing for them to do is hold for now, assess the risk, and then be prepared. Luckily, they're at a good point now with where policy is that they can react appropriately as the economy evolves to wherever those risks end up being manifested.
When this stuff starts happening in real time, it's hard to follow the data and feel like you have a good idea of what's actually happening. Are there different data points that you look to that can show you early on, kind of like the canary in the coal mine sort of issue? Because that's the criticism of the Fed, is that if you wait till this is in the data, it's too late, it's too hard to turn. What would you be watching right now?
Well, remember, the data also has a lot of contact with the actual people making these decisions, with firms, right, with households. You know, there's survey evidence that they collect themselves, and they also talk to their boards of directors and a lot of business contacts. You know, the Cleveland Fed has many, many advisory councils throughout the district, and even an energy advisory council. So there's lots of ways they're getting information about what's happening in real time on the ground. And I'm certain that that's feeding into also how they're looking at the economy at this point. So that gives you a very early indication of how many firms are reacting to what's happening in the economy as we go forward. And I think that'll be important as well. The real data
that's an interesting distinction, just the idea that, look, sometimes the criticism of the Fed is they don't know they're in this ivory tower. You're saying basically they know more than we do.
Well, I think they do a good job of collecting that information. I found it very valuable, during the pandemic and other times where the models aren't going to be necessarily that useful for the guide and a lot of the data is distorted, to be looking at really what people are telling you they're doing. And the Fed does that with their own surveys, but also in terms of talking to their advisors about what they're doing actually in response to higher energy prices. I'm sure many firms are telling them that, we're going to try to hold off and raising. This is what happened during the pandemic. We're going to try to hold off in terms of raising our prices because we don't want to lose customers. But at some point, if they start to hear that more firms are doing that, that's going to influence, I think, policy as well. So there's data. That's the hard data. There's data they collect themselves through surveys of their district firms. And then there's also the advisors who can tell them in real time how they're reacting and what their view of the economy is. And that all goes into determining where their view of where the economy is going. So I think the Fed is not just looking at backward-looking data. They're looking at forward-looking data as well.